This week I had a good entry with my broker IC Market, and so far, after taking partial profits, it is still generating profits for me and has already reached 200 pips. But let's explain how this strategy works and the profits it has given me so far. First, the strategy works by using order blocks, and the order blocks is we see the last candle reversal before the big impulse. But if we add to this using order blocks and imbalance, the strategy becomes much more powerful. You need to learn how banks invest, and then you will have some minimal chance of being able to make money in trading. The objective of the banks is not only to get rid of your money, but also to offer you liquidity. For example, if we want to sell a property, it will probably take a few months to sell it, which means that the property is an illiquid asset. On the other hand, if we want to buy or sell in trading, we can do it in seconds, which means that it is a very illiquid asset. Forex, stocks, cryptocurrencies, or futures contracts are liquid assets because they allow us to buy or sell them immediately, and this liquidity is provided by the banking algorithm, knowing that we have a great advantage to understand the incredible strategy that banks use to amass the huge fortune. The areas where there is the most liquidity within a chart are when the price turns around at these points is where the most buying and selling accumulates. If the chart were a car, each turn of the car would represent going to a gas station to refuel in order to continue driving. This is exactly how a banking algorithm works. Before making a downward movement, the bank will make a detour to look for the necessary liquidity, and once it has a full tank, it will spend it to continue driving. Once it has a full tank of liquidity, it will spend it on its way. When we see interesting support, most traders know that they should buy, as it is the lowest price, and they usually place the stop loss just below the support. Market manipulators are also interested in buying in that area, but if they make a big buy, the price would go up too fast without them having time to put a large amount of money into the market. That is where they make their master move. They make a small manipulation to the downside, just enough to trigger all the stop losses. Remember that each stop is a sale, so they get a large mass of investors to sell their positions to them at the cheapest price so they can make a large purchase and take advantage of the upward movement. When this manipulation happens, it is said that in that zone there are many bullish pending orders. Besides, other investors are interested in buying at that low price, and that zone is called order block or pending orders zone. When the price returns to that zone, what usually happens is that all those pending orders are activated and the price shoots upwards with great force. The strategy works as follows. First, we must detect a clear trend. In this way, all the investors will be clear in which direction to invest. In this case, we have a downtrend and everyone is clear that they have to invest downwards. Secondly, we must look for a strong downward movement on the chart that shows us that someone is manipulating the market as it triggers the stop losses. Stocks represent buying, and that is what the banks are interested in. It needs buyers when it intends to sell. So we make sure that the bank still intends to drive the price down, and that is when we should prepare our entry. We will look for an imbalance to add to our order block. The imbalance is the gap left by the market that needs to be filled. There will never be an empty imbalance. The market will always go to fill it, no matter how long it takes. It will always go for those pending orders. If we look at this chart, these orders were there since September and I came back for them 2 months later, confirming this theory. Adding the imbalance and our order block, we only have to look for our entry. For that, we must look at the chart in different time frames and not be afraid to lose. Let's use a reasonable stop loss, but always below the last low. In this case, if it is below the last low, since it is a bullish operation, but if it were a sale, our stop loss should be above the last. As we can see, the risk-benefit ratio of this strategy is really interesting. If we have correctly interpreted all the steps, what we should see is how the price goes down in a fast and clean way because all the sell orders that were in the zone have been executed. I use 15 to 30 pips stop loss and look for a take profit above 200 pips. This strategy works with all currencies. Put it into practice and let me know in the comments how it worked for you. I hope you liked this video and put this strategy to the test. See you in the next wave.